Welcome to the channel, where we help you master personal finance and investing. Today, I'm going to reveal the secret to multiplying your money like magic, using two different methods with the power of compounding. But what is compounding? Compounding is when your money makes more money on top of the money it already made, and it can skyrocket your returns over time. But how do you use compounding to your advantage? Should you put all your money in one shot, or should you spread it out over time? That's what we're going to find out in this video as we compare two popular investment methods, Lumpsum and Systematic Investment Plan, SIP. Both methods have their strengths and weaknesses, depending on what kind of fund you choose, what your financial goals are, how much money you have, and what your investment strategy is. We'll also see how each method impacts your cash flows, which are the money that comes in and goes out of your account. Additionally, I will also show you how each method performs in various market situations, including when the price of a fund is low or high, or when the market experiences a downturn. You will learn how to calculate your returns using both methods and how to pick the best one for your case. By the end of this video, you will learn how to use compounding to enhance your wealth through lump sum or SIP investments. Additionally, you will gain insights on making intelligent decisions that align with your specific needs and goals. So don't miss this chance to learn how to make your money work harder for you. Subscribe to the channel and hit the bell icon to stay updated on our latest videos. All right, let's start our financial adventure by exploring some potential investment options. Before we delve into investment options, let me share an incredible quote from renowned investor Peter Lynch. He once said, "An important key to investing is to remember that stocks are not lottery tickets." This quote reminds us that investing is not like gambling. We should take decision with proper research. Now, let's explore the various investment options that are available. Imagine this, you've got some extra cash and you're eager to make it grow. But with so many choices out there, where do you even begin? Don't worry, I've got your back. Here are some fantastic options to consider. Stocks, shares, mutual funds, and index funds. Each of these options comes with its unique characteristics and risks, but they all have one common goal to help your money grow while you sit back and enjoy the ride. So let's break them down one by one. Now let's see how to maximize the power of compounding by using SIP or lump sum method in stocks. All right, let's dive into the thrilling world of stocks. Imagine owning a tiny piece of your favorite companies, becoming a shareholder, and being part of their success story. That's what stocks are all about. When you buy a stock, you essentially buy a piece of ownership in a company. It's like having a front row seat to the company's growth and profitability, and guess what? As a shareholder, you're entitled to a portion of the company's profits in the form of dividends. But stocks can be a bit like a roller coaster ride. The value of stocks can go up and down based on various factors. It's like the stock market has its own mood swings. The performance of the company, economic conditions, or even investor sentiments can influence stock prices. Now, let me share a quick calculation example to demonstrate the potential of stocks. Let's say you invest $1,000 in a stock, and over the course of a year, that stock grows by 10%. Your investment would then be worth $1,100. That's a $100 gain just by being a part owner of the company. Speaking of stocks, here's a thought-provoking piece of advice from the renowned financial writer. Morgan Housel, the stock market is a device for transferring money from the impatient to the patient. What Morgan Housel means is that the stock market is a place where people who are patient and willing to wait for the right opportunities can make money from those who are impatient and want to make quick profits. In other words, if you are willing to hold on to your investments for the long term, you are more likely to see positive returns than if you try to time the market or make quick trades. So when it comes to stocks, it's important to stay focused on the long-term game and not get swayed by short-term market fluctuations. Next, let's see how to maximize the power of compounding by using SIP or lump sum method in shares. All right, let's dive deeper into the world of shares. Imagine you're at a financial buffet, and shares are like the various dishes laid out for you to choose from. Each dish represents a different company or asset that you can own a piece of. It's like having a diverse menu of investment opportunities. Shares, also known as equities, offer you the chance to become a shareholder in a company or a part owner of a mutual fund or exchange-traded fund, ETF. When you invest in shares, you're essentially buying a small portion of that company's success. It's like being part of a financial team. Additionally, shares give you the potential for long-term growth and income. Some companies even distribute a portion of their profits as dividends to shareholders. It's like receiving a delicious slice of the company's success. Another advantage of shares is their flexibility. You can buy and sell shares on the stock market, allowing you to adjust your investments according to your needs and market conditions. It's like having a dynamic investment toolkit. However, when it comes to choosing shares, it's important to diversify your portfolio. Instead of putting all your eggs in one basket, consider investing in shares of different companies across various sectors. It's like having a balanced meal that covers all the essential nutrients. Whether you choose to invest in individual shares or shares through a mutual fund or ETF, they offer you a fantastic opportunity to participate in the success of companies and markets. So go out there, embrace the world of shares, and may your investments flourish like a well-tended garden. Now let's explore mutual funds and discover how to maximize the power of compounding by using either the SIP or lump sum method. Mutual funds are the favorite choice for many investors. You may be asking yourself why. This is because when you invest in a mutual fund, you join forces with other investors, creating a large investment pool. It's like going on a financial adventure with your friends. The best part of mutual funds is that they're managed by experts who do all the homework and decision-making for you. You get to chill, enjoy, and let the pros do the hard work. Mutual funds often invest in a variety of stocks, bonds, and other assets, giving you a balanced and diversified portfolio. Let me explain this using this example. Imagine you and your friends want to go on a road trip across the country. You have two options. You can either buy a car with all your money, or you can chip in a small amount every month and rent a car. Which option would you choose? If you buy a car with all your money, you'll have a lump sum investment. You'll own the car, but you'll also have to pay for the maintenance, insurance, and gas. You'll also have to deal with the depreciation of the car over time. If the car breaks down or gets stolen, you'll lose all your money. If you chip in a small amount every month and rent a car, you'll have a SIP investment. You'll pay a fixed amount every month, but you'll also get to use different cars depending on your needs and preferences. You'll also have the flexibility to change your plan or cancel anytime. If the car breaks down or gets stolen, you'll still have your money. Which option sounds better to you? The answer depends on many factors, such as the price of the car, the duration of the road trip, the availability of rental cars, and your personal goals. The same logic applies to mutual funds. Sometimes lump sum investments can give you higher returns if you buy at a low price and sell at a high price. Other times, SIP investments can give you higher returns if you invest regularly and benefit from compounding. The key is to understand your situation and choose the best option for you. That's how you can maximize the power of compounding using SIP or lump sum method in mutual funds. By the way, if you're enjoying this video so far and want more content like this, comment the word more, so I'll notice. Next, let's see how to maximize the power of compounding by using SIP or lump sum method in index funds. They're like the cool, laid-back cousin of mutual funds. Instead of trying to beat the market, index funds aim to match the performance of a specific market index, like the S&P 500. It's like joining a race without trying to outrun anyone, just keep up with the pack. Because index funds aren't actively managed, they often have lower fees compared to other funds. Plus, they offer great diversification since they include a whole bunch of different stocks or assets within the index. It's like having a taste of the whole market in one go. Now, let me share a quick calculation example to show you the potential of these investment options. Let's say you invested $1,000 in a stock that grew 10% in 1 year. You'd end up with $1,100. But if you invested that same $1,000 in a mutual fund or an index fund that grew by the same 10%, your investment would also grow to $1,100. The difference is that with mutual or index funds, you're spreading your risk and potentially benefiting from the performance of multiple assets. So whether you choose stocks, shares, mutual funds, or index funds, remember that each option comes with its own set of benefits and considerations. Take your time, do your research, and find the investment avenue that aligns with your goals and risk tolerance. Now that we've got the basics covered, now let's dive into the difference between SIP and lump sum investments. All right, let's dive into the world of SIP and lump sum investments. I know these terms might sound like financial wizardry, but don't worry, I'm here to break it down for you so you can confidently navigate the investment waters. Ready? Let's go. First up, SIP, the Systematic Investment Plan. Think of SIP as your financial trainer. It's like having a regular savings routine for your investments. Here's how it works. You invest a fixed amount of money at regular intervals, whether it's weekly, monthly, or quarterly. It's like setting aside a portion of your paycheck each month for a rainy day, but instead, you're setting it aside for your investment portfolio. Pretty neat, right? Now, you might be wondering, why should I bother with SIP? Well, imagine this. You want to get fit, and you hire a personal trainer to help you achieve your fitness goals. That trainer creates a workout routine for you, and you stick to it religiously. Over time, you start seeing results. You feel stronger, fitter, and more confident. That's what SIP does for your finances. SIP promotes financial discipline by encouraging you to invest consistently. It takes away the stress of trying to time the market because you're investing regularly, regardless of whether the market is up or down. This helps you avoid making impulsive decisions based on market fluctuations. Instead, you stay focused on the long-term game, steadily building your wealth over time. The real magic of SIP lies in the power of compounding. Now, don't let that term scare you off. It's actually quite simple. Compounding is like a snowball effect for your money. You see, when you invest regularly, the returns you earn get reinvested. So over time, your investment grows not only on the original amount you invested, but also on the returns you earned. It's like a snowball rolling down a hill, getting bigger and bigger. Imagine you invest a small amount each month in a mutual fund. The returns generated on your investment are reinvested, and they start earning returns of their own. It's like a money-making cycle. As the compounding effect kicks in, your investment starts growing at an accelerated pace. It's like watching your money work for you while you sit back and relax. All right, now that we've got a grip on SIP, let's talk about lump sum investments. Imagine this. You have a big bag of money and you're itching to invest it. Well, that's what lump sum investment is all about, investing a large sum of money all at once. You might be wondering, why not just use SIP for this big bag of money too? Well, lump sum investments have their advantages too. Let's say you believe that the market is currently at a low point and poised for growth. Investing a lump sum in such a scenario could potentially lead to higher returns in the future. It's like making a strategic move in a game of chess. You're positioning yourself to take advantage of future gains. However, it's important to step carefully with lump sum investments. Just like in chess, not every move is a winning move. Timing is important, and there's always a risk involved. If you invest a lump sum at the wrong time, you could end up facing losses instead of gains. So it's essential to do your research and be informed about market conditions before making the leap. To sum it up, SIP is like a slow and steady marathon, while lump sum is more like a sprint. SIP helps you build wealth gradually over time, taking advantage of the power of compounding. On the other hand, lump sum investments offer the potential for immediate gains, but they come with higher risks. Now, I know what you're thinking, which one is better? Well, there's no one-size-fits-all answer to that question. It really depends on your individual circumstances and investment objectives. Some people prefer SIP because it allows them to invest with smaller amounts and build wealth over the long term. Others may prefer lump sum investments if they have a lump sum of money available and want to seize specific market opportunities. The key is to consider factors such as your financial goals, risk tolerance, available funds, and market conditions before making a decision. And remember, it's always a good idea to consult with a financial advisor who can provide personalized guidance based on your unique situation. So there you have it, SIP and lump sum investments simplified. I hope this deeper understanding helps you make more informed investment decisions. Now that we understand the fundamentals, the major difference between SIP and lump sum investment is the cash flows. Now let's talk how cash flows impacts. What is cash flow? Cash flows refer to the movement of money into and out of your investment. This is where SIP and lump sum investments differ. SIP allows you to make regular investments at predetermined times, resulting in a continuous cash flow. It's similar to scheduling a monthly finance meeting. You choose a monthly investment amount that you're comfortable with, and that money is withdrawn from your account and invested on a regular basis. It's a methodical technique to developing a disciplined investment habit. Furthermore, because you're investing smaller amounts on a monthly basis rather than a large lump sum all at once, it can be easier on your budget. Now, on the other hand, lump sum investments occur only once, resulting in a single cash outflow. It's like a financial love-at-first-sight moment. You have a significant amount of money that you want to invest, and you go all in by depositing the entire sum at one go. This can be an attractive option if you have a lump sum available, maybe from a bonus, inheritance, or savings. It allows you to make a substantial investment right away and potentially take advantage of market opportunities. So, you see, the major difference between SIP and lump sum investments lies in their cash flows. SIP involves regular investments, like a steady stream of financial commitments. It keeps you engaged with your investments on a consistent basis. On the other hand, lump sum investments offer a one-time cash flow, like making a big splash into the investment pool. If you prefer a disciplined and structured approach, where you invest smaller amounts regularly, SIP might be the way to go. It allows you to build a habit of saving and investing over time. On the other hand, if you have a lump sum available and want to take advantage of a specific market opportunity, making a lump sum investment can be a strategic move. Of course, there are considerations to keep in mind. With SIP, you need to ensure that you have a consistent cash flow to support the regular investments. It's important to choose an amount that you're comfortable investing without affecting your day-to-day expenses. On the other hand, with lump sum investments, you need to carefully evaluate the timing. You might want to keep an eye on market conditions and choose a time when you believe the investment has the potential to grow. Ultimately, the decision between SIP and lump sum investments boils down to your financial goals, investment objectives, and personal preferences. Some investors find comfort and discipline in the regularity of SIP, while others prefer the potential advantages of lump sum investments. It's important to assess your own situation and make an informed decision. I must mention that you're not limited to just one approach. Depending on your financial situation and goals, you might consider a combination of both SIP and lump sum investments. This allows you to enjoy the benefits of regular investing while also taking advantage of specific opportunities with a lump sum investment. That was quite a journey through the world of cash flows in SIP and lump sum investments. I hope you now have a clearer understanding of how the cash flows differ and how they can impact your investment strategy. So, why do investors choose SIP or lump sum? Let's explore the benefits and considerations of each approach. Benefits and considerations. Now, let's talk about the benefits and considerations of SIP and lump sum investments. Understanding these factors will help you make an informed decision that aligns with your financial goals and objectives. So let's dive in. First, let's talk about SIP, the superhero of regular investments. One of the key benefits of SIP is that it promotes financial discipline. It's like having a personal trainer for your finances, keeping you on track and accountable. By investing small amounts of money regularly, you develop a habit of saving and investing consistently. It's a great way to build a strong foundation for your financial future. Another advantage of SIP is the power of compounding. Let me break it down for you. When you invest regularly through SIP, your money grows over time. The returns generated from your investments are reinvested, and as the compounding effect kicks in, your investment starts growing at an accelerated pace. It's like a snowball rolling down a hill, getting bigger and bigger. So with SIP, you not only benefit from your initial investment, but also from the returns generated by your investment. Now, let's shift our focus to lump sum investments. The key advantage of a lump sum investment is the potential to seize a specific market opportunity. Imagine you have a lump sum amount available, and you spot an investment opportunity where the net asset value, NAV, of a fund is low. By investing the entire amount at once, you can acquire more units of the fund. It's like going shopping when there's a massive discount, you get more for your money. Lump sum investments require you to have a substantial amount of money available up front. It may not be feasible for everyone to have a lump sum amount ready for investment. In such cases, SIP provides a great alternative. With SIP, you can start investing with minimal funds and gradually increase your investment amount over time. Another consideration when choosing between SIP and lump sum investments is your risk tolerance. SIP allows you to spread your investments over a period, reducing the impact of market volatility. On the other hand, lump sum investments expose your entire investment amount to market fluctuations. So, if you're more risk-averse and prefer a more conservative approach, SIP might be the better option for you. To make an informed decision, it's always a good idea to consult with a financial advisor. They can help assess your specific situation and guide you in choosing the investment method that best suits your needs and goals. Remember, investing is a long-term game, and it's important to have a well-thought-out plan that aligns with your financial aspirations. Now let's address a common question that many investors have. The important question, what if there's a loss in the market? Will the invested price be the same, or will it also be a loss? Well, my dear investors, let's dive into this roller coaster of a topic. Investing in the market is like taking a thrilling ride at an amusement park. Sometimes you'll experience those heart-stopping drops, and other times you'll feel the exhilarating highs. In the world of investments, there's no guarantee of smooth sailing all the time. Markets are influenced by various factors, such as economic conditions, geopolitical events, and investor sentiments. These factors can cause prices to fluctuate, and sometimes they might even take a dip. Imagine you've invested in a mutual fund or a stock through SIP or lump sum. Now, the market experiences a temporary downturn, and the prices of your investments decline. Naturally, you might be concerned about the impact on your hard-earned money. The truth is, when there's a loss in the market, the value of your investments will indeed decrease temporarily. But before you panic, let's put things into perspective. Investing is a long-term game, my friends. It's not just about the ups and downs of today or tomorrow. It's about the journey over many years. Markets go through cycles, and historically, they have shown a remarkable ability to recover from downturns. The key is to stay patient and not let short-term fluctuations dictate your decisions. Let me share a simple analogy to illustrate this point. Imagine you're on a road trip, driving through beautiful landscapes. Along the way, you might encounter some rough patches or detours. But do you turn back and cancel the trip? Of course not. You keep going because you know that eventually you'll reach your destination and enjoy the breathtaking views. Similarly, when you invest, you're embarking on a financial journey. There will be moments of turbulence, but that doesn't mean you should abandon your investment plans altogether. In fact, staying invested during market downturns can be a smart move. Why? Because that's when you can buy more units of your investments at lower prices. It's like a sale at your favorite store, where you get to buy quality items at discounted prices. Now you might wonder, how can I stay calm and hold on when the market is going haywire? That's a valid concern. Remember that knowledge is power. The more you educate yourself about investing and market dynamics, the better equipped you'll be to handle market fluctuations. Additionally, diversification can be your trusty sidekick during uncertain times. By diversifying your investments across different asset classes and industries, you spread your risk. When one sector is facing challenges, another might be thriving, helping to balance out your overall portfolio. Let's address another aspect of the market that might put your mind at ease: historical data. Look back at market history and you'll see that despite all the bumps and bruises, the general trend has been upward. Now, I'm not saying the past guarantees the future, but it does show us that over time, markets have rewarded patient investors. So yes, there will be moments of loss in the market, and the value of your investments may temporarily decline. But don't panic. Stay invested, stay diversified, and keep your eyes on the long-term horizon. Remember, it's the overall journey that matters, and with time, markets have historically shown resilience and the potential for recovery. Just like the roller coaster ride that leaves you exhilarated at the end, investing in the market can have its ups and downs. Embrace the adventure, stay informed, and trust in your long-term investment strategy. Overall, maximizing the power of compounding with SIP and Lumpsum investments have their unique strengths and considerations. The key is to understand your financial situation and goals and choose the method that aligns best with your needs. Today, we went deep into the world of SIP and Lumpsum investments, exploring their characteristics, benefits, and considerations. SIP, the superhero of regular investments, promotes financial discipline and harnesses the power of compounding. Lumpsum investments, on the other hand, allow you to seize opportunities when the timing is just right. Remember, making an informed decision requires considering your financial goals, investment objectives, and the type of fund you're eyeing. This video is for educational purposes only and does not constitute investment advice. It is important to conduct thorough research and consult with financial professionals before making any investment decisions. The value of investments can fluctuate, and past performance is not indicative of future results. Always assess your risk tolerance and investment goals before allocating your capital. Now, if you want to know about assets that can help you earn money, I recommend you watch the next video in our series. Don't hesitate to share this video, subscribe to our channel, and share your thoughts in the comments section. Happy investing, my friends, and may your financial journey be as thrilling as it is rewarding. Thanks for watching, and I'll see you in my next video.